I know that, usually those type of selection process is a multi-dimensional framework and you assess multiple things, but I would like to ask you if you had to pick one single rule to assess a quantitative trading strategy or a quantitative trading team, what would it be? Anthony, would you want to start with this one?
Sure. Wow, you're killing me, Francois. I mean, I wish our industry was, simple enough, or I knew enough about the industry to be able to encapsulate everything in one golden rule. I mean, it's a tough task, but the way we look at things, I think originality is is key. You have the brightest, most talented minds going at it every day, trying to figure out to crack the code. And at the end of the day, it's dog eats dog. If you're not doing something different, you won't be able to harvest alpha. It's a zero-sum game after all. So you have to either, in fishing terms, even though I'm not a fisher, I don't know why I'm going to go down that route. In fishing terms, you either have to fish in a different pond than the rest of the fishermen, or use a different or a better fishing rod. In trading terms, you either have to access markets that people are not accessing, which is very hard to do these days, just because it's a globalized thing. Like, it's not very, other than China, it's not hard to access futures or equities and stuff like that. So, either do that and find specialized managers. I know there's a panel on esoteric specialized managers, and there's always alpha there, just because big institutions don't have the know-how. And if you do have the know-how, and like nat gas, for example, there are alpha streams where you could harvest there. And the second thing is you have to trade differently. And by that, I mean, just doing it in a way that other people are not doing. And that's obviously that's a holy grail. That's the hardest thing to do. But it's also the one that guarantees you slower the edge evaporates slower than just accessing something that somebody else isn't. Because, again, as I said, the most brilliant minds are at it. So they're gonna find a way to access those markets you are, if you're doing something different.
And Bastien, what would be your tip or advice on this?
I fully agree on Anthony's take. It's certainly talent. Some kind of unique niche approach is a good starting point as a pre-selection criteria. When looking at numbers and results, we would probably first look at correlations, and also make this also a very key aspect about the entire selection process. Low or negative correlations, arguably, to markets. So if you think about the S&P, that you can distill how does a manager or program do in up markets and down markets, not just in general, and basically maybe even have anti-correlation, despite the fact delivering positive returns in both scenarios. So we happen to have ended up investing predominantly on the absolute return side in the past couple of years. There are special circumstances with less liquid strategies where we also do invest on the family office side in real estate and these projects. But looking from a trading perspective, it has been niche, smaller managers because of capacity constraints, not necessarily because they haven't been around for many years. You can have been around for many years, but because you're more on a capacity constrained niche strategy, you may end up staying small because there's not much capacity left in that specific field. And the correlation aspect is arguably something everybody refers to, but it's very often not really applied, because if you think about crises, we have just seen it again in March. Asset classes which are historically not necessarily correlated show these nasty tendencies to increase their correlations in times of crisis. This may be due to structural reasons, liquidity reasons. We saw gold falling in March across the board, bonds, equities, so there was no place to hide, or pretty much not many places to hide. Vasant mentioned in the previous panel that short-term momentum basically, and being long vol, structurally long vol or generally long vol was very helpful. And one way to identify that is to look into correlations in different time periods, specifically in times of crisis. And we have made this a key criteria, certainly with a bias, because we as a manager on the depleted capital side are intraday and short-term trading as well. There's a natural tendency to look into that field, and we are pulled towards these managers who have compelling characteristics there, but correlation is probably the most important cornerstone for us in the selection process.
And at which time frame do you look at this?
Across the board.
Daily basis, monthly basis, intraday?
Yeah, basically the most important is minimum daily. Even better intraday, of course, but daily is the absolute minimum. It defeats the purpose when you look at monthly or yearly correlations, basically, because you can have hidden risks there where your portfolio, the way you have built it, is suddenly aligned. Imagine in the midst of March, where the heat hits the market. That's basically where you would like to have these anti-correlation characteristics present. And it doesn't really help you if there's no correlation before that and no correlation afterwards, but exactly when you need it, then it's disappearing. So we would always recommend to use daily. We are always worried when our investors are asking us for data and they sometimes look on annual or only monthly. We sometimes force feed them the dailies so that they please have a look there. And then look at the different market scenarios. It comes with analytical skill sets, capacities, so not everybody has that in-house, so we offer that as well. If an investor has a portfolio, we say, give us your portfolio dailies, and we put it together and we produce your nice quant report so you can see how our various programs behave in regards to your portfolio in different circumstances. So we think it's really important to do that. And if someone can't do it in-house or doesn't want to do it in-house, I think it's important that managers support their investors in showcasing how their programs and approaches behave in different circumstances and what kind of effect do they have on an investor's portfolio.